this week's market update, strong US employment data point to tighter policy. Philip Hammond presents the new style low-key spring statement, and investors respond to the threat of trade wars. The theme of 2018 to date had looked like being goodbye Goldilocks. The favourable conditions which had made 2017 such a good year for investors have seemed to be in reverse in the first couple of months of this year. But not too hot, not too cold was certainly the market-friendly story at the end of last week. Stocks were on the up again on Friday, with Nasdaq hitting a new record high and the S&P 500 rising over the week by nearly 3%. US non-farm payroll employment data was better than hoped for, with 313,000 new jobs created last month. That was about 100,000 more than forecast. That might have been bad news for equities had it been accompanied by strong wage growth and falling unemployment. But average hourly earnings only nudged higher by 0.1%, which pulled the year-on-year increase down from 2.9% to 2.6%. It looks as if both the demand for and the supply of labour is increasing, so breaking the usual link between rising employment and inflation. The Goldilocks combination of robust growth but subdued inflation and therefore lower for longer interest rates seems to have legs. On the face of it, that's good news for equity investors. In reality, it probably doesn't change much because the Federal Reserve under new boss Jay Powell seems determined to stick to its guns on monetary tightening. The 10-year Treasury yield briefly climbed above 2.9% again as investors started to price in the likelihood of 4, not 3 rate rises in America this year. We'll find out soon enough because the Fed's rate-setting meeting next week is expected to deliver the first of those quarter-point hikes. Stocks, however, were given a second boost at the end of last week after Donald Trump once again took everyone unawares by promising to meet with North Korean leader Kim Jong-un within weeks. That news followed an apparent thawing of relations between North and South Korea during the Winter Olympics and the apparent offer from the North to suspend nuclear and missile tests. After the initial flurry of excitement, questions have started to be raised about who is the real winner from this new rapprochement. Donald Trump clearly relishes the possibility of being the president who finally breaks the 70-year deadlock on the Korean Peninsula. A more cynical interpretation sees Kim as the real victor here, playing on the US president's vanity and willingness to act without consultation to legitimize his regime in the eyes of the world. Still, the tensions created by last year's North Korean missile launches have certainly been ratcheted down a few notches. Most obviously, this was reflected in a weakening of haven demand for the Japanese yen. It was also a useful counterpoint last week to the very market-unfriendly developments on the global trade front. Last week, Donald Trump shrugged off the resignation of his pro-free trade chief economic advisor Gary Cohn to confirm his intention to impose tariffs on US imports of steel and aluminium. The move has been watered down a bit as Canada and Mexico have been exempted while negotiations continue on the NAFTA free trade agreement. But the threat of a trade war remains very real as tit-for-tat retaliation is considered by America's very irritated trading partners. Both Europe and China are considering how they might respond to US tariffs, with targeted taxes on iconic American brands, which were nicely captured by a newspaper headline last week that will be familiar to fans of 1970s pop music. A levy on the Chevy, tax your whiskey and rye, it read. Trade wars tend to be bad news for investors. The economic logic for imposing tariffs is a great deal weaker than the short-term political benefits at home. This seems particularly so with the latest tariffs because the beneficiaries in America's Rust Belt, that's the steel workers who've been priced out by cheaper foreign imports, are vastly outnumbered by workers in industries like car manufacturing, which will be hit hard by higher input costs. Investors are tending to shoot first and ask questions later as they become more nervous about a turn in the 9-year bull market since the financial crisis. As a consequence, more than $10 billion was pulled out of US equity funds last week. Fund flows into European and emerging market funds was also sharply lower, although positive, while Asia-Pacific funds took in around $4 billion as the view grows that the region is less exposed to a trade slowdown than it has been in the past. Now, although US equity funds had a bad week, the crown for least loved market at the moment continues to be worn by the UK. A monthly survey of big investors by Bank of America Merrill Lynch showed that UK equities were the least popular in the world. They've not been more out of favour since the crisis in 2008. Investors in both public and private equity markets are loath to commit capital to a market where there is so much short-term uncertainty. And it's not just professional investors who are turning their backs on Britain. Retail investors have pulled £5.5 billion out of UK funds since the referendum in June 2016, according to the Investment Association. The key question now is whether, with so much negative sentiment about the UK, contrarian investors will start to find bargains in a market whose valuation looks increasingly attractive compared to other developed markets. While these kinds of bottom fishers are increasingly in evidence, so too are the hedge funds betting the other way, looking out for structurally challenged businesses to short sell in hard-pressed corners of the UK economy like restaurant chains and high street retailers. The UK will be in focus this week thanks to the Chancellor's spring statement, which has now replaced the budget as the main economic set piece for the government in the first half of the year. The budget moved to the autumn last year and will from now on be the main opportunity for the Chancellor to announce tax and spending changes. The spring statement is being billed as a deliberately low-key event. Presenting the statement on the UK's growth and borrowing, the main purpose of the speech now, has been made easier by slightly higher growth expectations on the back of improving productivity. That, in turn, has taken the pressure off the public finances, with higher tax receipts pointing to a lower than forecast deficit for the year to April. And meanwhile, on the corporate front, there's a mixture of earnings, takeover and IPO news this week. Earnings season is drawing to a close in the US, but there are still a few interesting reports expected, especially on this side of the pond. Antofagasta will be watched closely for news on the Chilean copper miners' margins after it warned in January that they were starting to come under pressure from rising costs. Commodity prices are often a strong performer in the later stages of an economic cycle, but profits at the companies that extract the natural resources usually also come under pressure in due course as their costs follow suit. Also in the spotlight this week will be Inditex, the Spanish retail giant which owns the Zara fashion chain. Its full-year results will give some guidance on the impact of the strong euro on European exporters' profits. Its shares have slumped by a fifth over the past year. And the tech stock rally, which has been the principal driver of market growth in recent months, will come under scrutiny as Adobe, maker of Photoshop, looks to build on a 25% rise in fourth quarter profits. It's done well out of the shift from consumers purchasing one-off software licenses to a more subscription model. Its shares, in keeping with many other tech shares, are up 80% in a year as investors start to hear echoes of the 1999 dot-com bubble. On the takeover front, the big story in the UK is the ongoing tussle for control of GKN, one of the longest established companies on the British market. Melrose, which wants to acquire the engineering company, this week raised its bid to £8.1 billion and said it would not raise the offer further under any circumstances. The bid has been controversial, raising fears that a key part of British industry may be dismembered and possibly sold to overseas buyers. GKN has rejected the final offer. And finally, the world's biggest flotation of Saudi state energy company Aramco is expected to be delayed until 2019. The deal, which would value the company at a cool $2 trillion, comes as advisors apparently struggle to garner enough interest for the 5% of Aramco on sale at that price.